What if you could beat 90% of professional Wall Street investors by doing absolutely nothing? In this video, we are breaking down the simple three-fund strategy that lets you automate your wealth and retire early without touching a single individual stock. Welcome back to the channel. If you are tired of checking stock charts, feeling overwhelmed by market news, or worrying that you are not saving enough for retirement, you are in the right place. Most people think that to build real wealth, you need to find the next Apple, Tesla, or Nvidia. But the data shows a completely different story. Trying to pick individual stocks is a losing game for almost everyone. In fact, over a 15-year period, more than 90% of professional fund managers fail to beat the broader stock market. These are people with Ivy League degrees and supercomputers, and they still lose. So, how do you win? You stop playing their game. Instead, you buy the entire market. This is called index fund investing, and today, we are going to look at the legendary three-fund portfolio. This strategy is incredibly simple, takes less than 10 minutes a year to manage, and has a proven track record of creating millionaires. Let us dive in. The first pillar of your portfolio is a total U.S. stock market index fund. This single fund gives you ownership in thousands of public companies in the United States. When you buy this fund, you are not betting on one company. You are betting on the entire American economy. You get exposure to massive tech giants like Microsoft and Apple, mid-sized companies making everyday products, and small up-and-coming businesses. If one company goes bankrupt, it does not hurt you because it is just a tiny fraction of your portfolio. And as new companies grow to dominate the market, they are automatically added to your fund. You do not have to do any research. Excellent examples of this fund are the Vanguard Total Stock Market ETF, ticker symbol VTI, or the Fidelity Total Market Index Fund, ticker FSKX. These funds have incredibly low fees, often costing you just a few dollars a year for every $10,000 you invest. By keeping your costs low, more of your money stays in the market, compounding over time. The second pillar is a total international stock market index fund. While the United States economy is incredibly strong, it does not represent the entire world. Some of the most valuable and innovative companies are based outside of the United States. Think about brands like Nestle, Toyota, Samsung, or ASML. By adding an international index fund, you are diversifying across different currencies, economies, and political landscapes. This protects you if the U.S. economy goes through a prolonged period of slow growth. A great choice for this is the Vanguard Total International Stock ETF, ticker VXUS, or the iShares Core MSCI Total International Stock ETF, ticker XUS. This fund ensures that no matter which country dominates the global economy in the next decade, your portfolio will capture that growth. The third and final pillar is a total bond market index fund. While stocks are great for growth, they can be highly volatile. They go up, but they also go down. Bonds, on the other hand, act as the shock absorbers for your portfolio. When the stock market crashes, bonds usually hold their value or even go up, providing stability and paying you regular interest. Having a portion of your money in bonds prevents you from panicking and selling your stocks at a loss during a market downturn. It also gives you a pool of safe money you can use to buy more stocks when they go on sale. A classic option here is the Vanguard Total Bond Market ETF, ticker BND, or the iShares Core US Aggregate Bond ETF, ticker HG. Now, you might be wondering, how do you actually put these three funds together? The beauty of this strategy is that you can adjust the mix based on your age and how much risk you are comfortable taking. If you are in your 20s or 30s, you have decades before retirement. This means you can afford to take more risk for higher growth. A popular allocation for young investors is 80% stocks and 20% bonds. Within that stock portion, you might put 70% in U.S. stocks and 30% in international stocks. As you get closer to retirement, you will want to protect the wealth you have built. You can easily do this by gradually increasing your bond allocation to 40 or 50%. This shift keeps your money safer when you need to start withdrawing it. The real magic of the three-fund portfolio is how easy it is to automate. Once you set up your accounts with a brokerage like Vanguard, Fidelity, or Charles Schwab, you can set your investments to run on autopilot. Every time you get paid, A set amount of money can go straight from your checking account into these 3 funds. You do not have to think about it, you do not have to timing the market, and you do not have to worry about the daily news. This is called dollar cost averaging, and it is the single most effective way to build long-term wealth. You buy fewer shares when prices are high and more shares when prices are low. Over 10, 20, or 30 years, this compound interest turns small, consistent investments into a massive retirement nest egg. Investing does not need to be complicated to be highly effective. By owning the entire world economy through just 3 simple index funds, you are setting yourself up for financial freedom with zero stress. If you found this video helpful, please hit that like button and subscribe to the channel. It really helps us grow and create more content to help you take control of your money. Let me know in the comments below which index funds you are currently holding. Thanks for watching, and we will see you in the next video.